Housing market is still in a record bubble. Home prices are 30 to 35% overvalued compared to their long-term norms. On a national basis, home prices are still climbing year over year. However, on a month-over-month basis, they are dropping in many markets, as well as a year-over-year basis dropping in many markets. And so the housing market right now is very bifurcated, and we actually have many cities that are entering a crash stage right now. This is what the mainstream headlines on the housing market are absolutely ignoring and missing, is the fact that in states like Florida and Texas, we are seeing a colossal spike in inventory and homes for sale. We're seeing a major sell-off take place that's now causing prices to go down, and I suspect this could be the start of a very large correction. I mean, there's certain states where I don't think home prices are going to go down that much. A state like New York would be one of them. Home prices aren't very overvalued there, inventory is still very low. However, if your state is overvalued, and if there was a lot of speculation that occurred during the pandemic, there's a huge chance that prices are going to drop. And so Texas and Florida, they're feeling it first because they were kind of the most speculative markets. But yes, it's reasonable to expect that this will spread to other parts of the country, although with varying degrees of how much prices go down. That's a key point to understand. So it's actually two things, Adam. One is, first of all, just seeing inventory up 70% year over year negates the idea that there's a housing shortage to begin with, right? But then when you see it now at or above pre-pandemic levels in an environment where the home sales and buyer demand is in the tank, that's really telling you, like, not only is there no shortage, there's actually a surplus of homes on the market. There's a surplus of homes on the market. The months of supply of homes is rapidly increasing. In a market like Austin, the months of supply is the highest it's been in 12 to 13 years. And so we're seeing more and more of that happen in different markets across America. So if you're a home buyer or a real estate investor or just a seller or someone who owns your house and just wants to understand the direction of prices, understand that it's so important that you know those trends in your market, because we're seeing many states and cities and even neighborhoods that are completely shifting overnight. Inventory is up in some cities. Inventory is up 1,000% the last 3 years. This is a rapidly changing environment that's a signal of what's to come for the housing market more broadly. The high mortgage rate environment and the low home sale environment is restricting inventory. So when mortgage rates eventually drop, who knows exactly when that's going to be, maybe I'll have some predictions for that, that will free up a lot more new listings to come to the market. So when that happens, inventory is going to spike even further. In addition, any type of potential labor market pain that could be coming in terms of layoffs or job losses could lead to mortgage defaults, foreclosures, or just forced selling or in short sales. So there's so many ways that inventory can actually increase further into the future. So the fact that we're already seeing this skyrocketing homes for sale level, like in some cities, what's going on, it's mind-bending. The fact that we're already seeing that now is a warning that things can get much, much worse in the future. And when I say much worse, I want to be clear, not trying to be negative here on the housing market, trying to actually kind of almost give you guys some hope if you're a buyer out there, and you've been waiting and you've been seeing these ridiculous prices in many markets like Texas, Florida, Tennessee, Arizona. Understand that relief is already on the way and the relief is coming, and that prices in these markets should get cheaper. I think the way to think about mortgage rates is what's it going to take to get a first-time buyer back into the market? And if the Fed cuts rates 1 or 2 times by the end of the year, that should push mortgage rates to 6.5% down from 7, where they're at right now. So they're at 7% right now. Maybe at the end of the year, they're at 6.5. Is that enough to entice a first-time home buyer back into the market? That's about an 8% decline in their monthly payment. I don't think so. Home buyer sentiment's at the worst rate in history, according to Fannie Mae, as well as according to the University of Michigan Consumer Sentiment Survey. I mean, the affordability is so bad right now, and Americans are so stretched and strained in their ability to afford things due to inflation, now being mixed with a job market that's looking increasingly insecure. Mortgage rates going down 50 basis points is not going to really do it for most home buyers. And so I am very skeptical of the notion that a couple rate cuts is going to push home prices up. I think rather the headwinds we're seeing in the economy that are developing is something that could just keep buyers on the sidelines, especially once home prices start going down. This is the other thing to understand, is like there's this perception out there that once home prices start dropping, all the buyers are going to flood back in. But that's actually not what's happening in a city like Austin. In Austin, home prices are down almost 20% over the last 2 years. There's been no bounce back in buyer demand, and inventory is just continuing to increase. Prices now in Florida are really starting to go down in many markets. Buyer demand is not going up. In Boise, prices went down by quite a bit. Buyer demand really didn't go up. And so the other thing to understand is that when it becomes obvious in a housing cycle that we're in the down cycle, buyers all of a sudden realize that they have time on their side. And all of a sudden there's this FOMO or this competition that's gone. And rather it's kind of like, let's see how far the values could drop. And so, it's a bit of a long-winded answer, but I would be very skeptical of thinking that a couple rate cuts is all of a sudden going to propel the housing market forward when we're already seeing this big spike in inventory occur in about half the states in the US. Real estate investors are not buying in the market anymore. Investor purchases are down 60% from their pandemic peak. We're actually seeing many of these investors sell. I'm going to show you actually a listing right now on Zillow. I went to this listing in Florida, actually. I saw it for myself. It's in a town called Punta Gorda, which is on the southwest side of Florida. Important that you guys pay attention to what's going on in this listing. You can see it's on the market for $336,000, 3-bed, 2-bath, right? Take a look at the listing history here. First of all, take a look at the Zillow value estimate over time, right? Yeah. You can see how much it's gone down. But what's really interesting is what this house sold for in May 2022. It sold for $445,000. So the current owner is taking a 25% loss 2 years later. Just so happened that the owner of this home is a company called First Key Homes. They own 48,000 homes across America. They're one of the top 10 largest Wall Street landlords in the country, selling at a 25% loss from what they bought it for 2 years ago in Florida. And so rather, the narrative that's applicable to the housing market right now is not investors buying, it's investors selling. There's many investors who bought over the last 2 or 3 years who bought at the peak who are now in distress. They bought rental properties, they can't rent them out. They bought Airbnb properties, their short-term rental revenues have plummeted. As a result, many of them are now being forced to sell their home. And so I want to be so clear with people about this, because the mainstream narrative is still, yes, oh, the Wall Street boogeyman is buying up homes. That is not happening right now. The reverse is happening. And ultimately, this is what also happens in the beginning of a housing cycle downturn. The investors, they were the first ones to pile in, push prices up. They are the first ones to get out. They don't own these homes for fun. They own these homes to make money. And if they're not being able to rent out the property and their rental rates are going down and their insurance costs and property taxes are going up and they're seeing the values in the market go down, yes, it makes financial sense to sell and get out in many cases, and that's what many of these investors are doing. And this is a risk factor that most people in the housing market don't understand. You're right, you and me have been talking about this over the last 1 to 2 years. There is so much risk from these investors facing more financial strain and needing to sell. And it's not just the big investors. The big investors are actually only maybe 20% of all the investor homes. The rest of the 80% of investor homes are like mom and pop or like medium-sized investors. So if like the big guys are having issues, you can bet that some of the smaller investors are also having issues. And yes, they tend to concentrate in the same neighborhood. And I want to show you a map right now. And this is, again, data on reventure app tracking inventory trends in different markets. And here we're looking at Houston. And you can look at any city in the US here on reventure app, but I want to show you what's going on in Houston because it really confirms this point you're trying to make. We're looking at a data point called the inventory surplus or deficit. How much inventory is higher or lower than the long-term average? And what you can see in these zip codes in red is that inventory is like double the long-term average already. And so let me just show you like here in 77026. Before the pandemic, we had 36 homes on the market for sale. Now we have 110. This is exactly what you are describing. This is an investor-concentrated zip code in Houston where there's a massive sell-off occurring right now. And what you can see is that there's like a big concentration, in this case, to the north and to the east. Meanwhile, take a look at this bifurcated housing market and some of the wealthier areas to the west of Houston. You can see inventory still in a shortage, down 40% from normal, down 20% from normal, down 45% from normal. And so this is a perfect picture of the housing market we are facing right now. If someone's a buyer on the west side of Houston, they are still experiencing bidding wars. They are still experiencing a rising price environment. Someone's a buyer in these areas in red on the north side of Houston, all the way kind of up to the northern suburbs. It is not that way at all. It is a housing downturn. Prices are going down and inventory is skyrocketed. So I hope kind of that helps show you kind of what's occurring right now. And yes, it's those investor zip codes, which also happen to be sometimes lower income zip codes as well, where some of the local homeowners, unfortunately, tend to struggle more in economic downturns. And I think there's also some kind of local homeowners being forced to sell in those zip codes as well. And that's where the downturn is starting. Honestly, I would keep it a little simpler, maybe for most home buyers. Understand the inventory trends in your market, right? Like if they are spiking right now, like, that's a telltale sign that the market downturn has started. There's fewer buyers, there's more sellers. Also look at the price cuts. One of the strongest indicators of the future direction of prices is the price cut rate, the percentage of listings in an area that has a price reduction. If you look at those two data points, which on reventure app, I combine them and some others to create a score for every zip code. But if you look at those two data points, you will kind of know the trends in your market in the short term. The other question to ask is, what's the fundamental downside, right? Okay, so we can technically say, oh, the market's doing up or down in the short term and will likely go up or down in the next 6 months. But what about like how much could prices actually drop in a worst case scenario? That's a really important one to understand too. I track overvaluation rates for every city and zip code in America, how over or undervalued home prices are to their long-term norms, kind of similar to like a PE ratio with stocks, kind of looking at the fundamental value there. And if you're in a zip code that's very overvalued and where inventory is spiking and price cuts are spiking, that says big downside risk. Conversely, if you live in a zip code that's not very overvalued or could even be undervalued, has low inventory and low price cuts, that says a stable market or one where prices could even continue to go up. We've reached that point in the cycle where the investors are now going to be more your friend in terms of the sell-off. The one thing to understand, though, is at the bottom of the downturn, the investors will be back buying, right? So the ones who are really getting hit right now are the ones who really expanded their portfolios in 2021 and 2022. That's what First Key Homes did. Other investors like Invitation Homes, they didn't really buy as much during the pandemic. They're more secure. And I bet you, speculating, I bet you some of those investors are probably going to scoop up some properties once values go down enough. So I think it's still a mixed story on the investor. On one hand, yes, these investors will be cutting prices in many markets and pushing inventory on the market will be good for you as a buyer, but don't forget, they'll be back. They'll be back at some point once prices drop enough, because basically the way these investors work is they're cash flow oriented. So they buy a house and rent it out. And right now they get at prevailing market prices and rents, they maybe get like a 4.7% annual return. Take the rent, deduct the expenses, divide it by what they purchased the property for. That's not very good. And so a lot of these investors, they want like a 6.5. They need a 6.5 in order to be able to even participate with where interest rates are. And so for that to happen, the prices need to drop 30%. And so I think once the prices go down enough, you will see some of the investors eventually come back in, but it's going to take time. It's going to take time to happen because home prices operate on a lag. And I see this actually in my home market of Nashville, where I live full time. The inventory in Nashville spiked. The price cuts have spiked, but there's still actually many sellers who list their house like at a crazy price and who are just completely ignorant of what's going on in the market. And that's because many sellers on resale homes, they just get so attached to their house and what they think it's worth. In many cases, it takes years for many of these sellers to get with the idea of where the market is. Whereas the investor or the builder, they're much more objective. They're much more about just finding the market clearing price to sell. So understand that there is also a lag. And that lag often takes years, and housing downturns often take years, which is another interesting topic unto itself, like when the bottom actually might be.